Welcome to the Riskwiser Zone. I'm your host, Lewis. Today, we're navigating a complex landscape of geopolitical tensions, market volatility, and economic uncertainty. As we dive into the world of stocks and finance, let's take a closer look at the current situation. The conflict between the United States, Israel, and Iran has sent shockwaves through global financial markets, causing crude oil prices to surge and prompting a shift towards risk aversion. On Monday, Indian equities saw heavy selling pressure as investors reacted to the expanding conflict in West Asia. The Sensex and Nifty opened sharply lower and remained under pressure for most of the session before trimming some intraday losses. According to analysts, the core concern for Indian markets remains oil, with tensions threatening energy flows through the Middle East. A sustained disruption could complicate the interest rate outlook and weigh on corporate margins, particularly in oil-intensive sectors. Market participants are also factoring in global cues, as Wall Street has corrected sharply to the evolving situation. Technically, the Nifty is hovering near important support levels after the recent slide. A break below recent swing lows could extend the correction, while any stabilization in oil prices may offer room for a relief bounce. Brokers are advising investors to avoid aggressive positioning and focus on capital preservation, given the uncertain backdrop. In other news, trading on Indian stock exchanges, NSE and BSE, has resumed as normal after the Holi festivities, with the official market holiday being observed on Tuesday, March 3rd. The next scheduled holidays are Ram Navami on March 26th and Mahavir Jayanti on March 31st. As we continue to monitor the situation, it's essential to remain informed and adapt to changing market conditions. We'll be keeping a close eye on developments and providing you with timely updates and insights. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of tech and finance, where two fascinating stories have caught our attention. First, let's talk about Nvidia, the giant in the tech industry. Despite posting impressive earnings, with revenues rising 73% year-over-year, their stock took a hit after the report. It seems the bar is always set high for this company, and markets expect more than just a mere earnings beat. Now, some analysts have raised their target prices for Nvidia, with several setting their sights on $300. However, there are also concerns about the sustainability of their revenues, particularly given the concentration of their sales among hyperscalers. The company is trying to address these concerns by highlighting the diversification of their demand profile and growth in areas like sovereign AI and physical AI. On the other hand, we have the story of Nvidia's partner, a company that's been making waves in the tech industry with its innovative solutions. This company has been working closely with Nvidia to provide cutting-edge technology to their customers. Their stock has been performing well, with some analysts predicting further growth. It's also worth noting that another company, a major player in the tech industry, has been making significant investments in AI research and development. This could potentially disrupt the market and impact companies like Nvidia and its partners. As we navigate this complex landscape, it's essential to consider multiple perspectives and potential risks. We'll continue to monitor these developments and provide you with updates and insights. In other news, a recent report highlighted the growing importance of artificial intelligence in various industries. This trend is expected to continue, with more companies investing heavily in AI research and development. As we move forward, it's crucial to stay informed about the latest advancements and their potential impact on the market. Welcome back to the Riskwiser Zone. As we wrap up today's show, I want to dive into a couple of stories that caught my attention in the world of crypto and banking. First off, let's talk about the recent warning from HMRC regarding crypto taxes. It seems that many traders are unaware of their tax obligations when it comes to cryptocurrency, and experts are urging them to get professional help to avoid any potential penalties. Now, I know some of you might be thinking, but Louis, I'm just a small-time trader. I don't need to worry about taxes. Well, let me tell you, the taxman is getting smarter, and they're cracking down on crypto traders. So, if you're buying, selling, or trading cryptocurrencies, make sure you understand your tax obligations. On a related note, there's been some interesting developments in the US regarding a proposed piece of crypto legislation called the Clarity Act. The bill aims to clarify the regulatory framework for cryptocurrency, but it's facing opposition from big banks. According to reports, President Trump has lashed out at the banks, accusing them of undermining the country's crypto agenda. Now, I'm not here to take sides or get into politics, but what's interesting about this story is that it highlights the ongoing tension between traditional financial institutions and the emerging crypto industry. As we've discussed on this show before, the rise of cryptocurrency is forcing regulators and lawmakers to rethink their approach to financial regulation. So, what does this mean for investors? Well, as always, it's essential to stay informed and adapt to changing market conditions. The crypto space is rapidly evolving, and regulatory developments can have a significant impact on prices and market sentiment. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.